Good afternoon, everyone, and welcome to today's webinar. My name is Michael Corgett, and I'm one of the advisors here at the Retirement Group. We want to thank you for joining us today. We at the Retirement Group do focus on working with employees of Fortune 500 companies like yours, helping them to achieve a successful and comfortable retirement. This is just one of the many resources that we have and offer to you to help you educate you to achieve that comfortable retirement. The webinars, we also have resources like our ebooks library, um, our retirement guides that are specific to your company, as well as our blog and our newsletter, excuse me. One of our probably most important resources is our cash flow analysis, which is what we call our Retire Kit. It is a very comprehensive snapshot of your current situation and looks into the future like a roadmap as to whether your retirement is going to be comfortable or not, whether it's a month away, a year away, or 5 years from now. It's a complimentary service, and we would be happy to put one of these together for you. All you have to do is ask. Just a couple things. We at the Retirement Group are an independent financial planning organization. We're not affiliated with Boeing or Northern Trust. We are independent, and I just wanted to point that out. And with that said, I want to go ahead and introduce my partner, Patrick Ray. Patrick.
Hey, thanks, Mike. Welcome, everyone. As Mike had mentioned, my name is Patrick Ray. I am one of the retirement advisors here with the Retirement Group. We appreciate your attention this afternoon. Hope everyone is enjoying their day. And hopefully what you'll find is after you spend a few minutes with us this afternoon, you'll have learned a little bit about what we have to talk about. We do these webinars on a pretty regular basis. And mostly the access to the things that we've done in the past are dropped into links that you have access to into the chat. And so feel free to peruse those at your own leisure when you have access to and or time to look at those, because they cover a myriad of topics. Today's topic is pretty special. We're going to cover what is an effective three-part series to our value discussion, which is our belief in how we invest and proceed with helping people manage their retirement assets. And so we're going to talk a little bit about the incorporation of the government spending and some of these things that have ultimately a ripple effect to most of us from an economic perspective. And so, as Mike had mentioned, we do a lot of planning with Boeing folks. We have a team of advisors that are placed all throughout the country where their offices are located. And we have a pretty intimate knowledge of your savings plan and your pension plans and your 401k plans and healthcare plans and things of this nature to try to guide you and basically to give you some real feedback and to effectively stress test through a cash flow projection, which is an effective complementary service that we offer to give you an idea on where you stand, whether you're 3 months or 3 years or longer away from retirement. We feel like this is a really useful tool for you to proceed with trying to find out where you are to see if you're in financial position to leave the payroll. And so I want to point out that there's a code that's on the screen right now that I'd encourage you to scan for future reference, which is access to our LinkedIn page. As we do these webinars, they end up being live on the LinkedIn access page, and sometimes it's a little easier to follow along in case you're doing some things along the work front that you just want to follow in the background. So that's a good way to do that. And so for today's agenda, we're going to talk about the economic environment today and ultimately what might be happening in the not too distant future. And, typically when you have an influx of government funds, which have been poured into our economy through the stimulus packages, you're going to end up having higher tax rates. And so ultimately what this is going to end up yielding is the net inflation, which leads to higher interest rates. And then we're going to talk about how that impacts us throughout this three-part series. And so most of what we have to talk about today is the expenses as a retiree. And so what's unique about the situation with expenses and specifically inflation is what purchasing power means to your ability to buy things. And so of course, over time, the value of your dollar erodes. And so the one beneficial thing you'll get from the cash flow analysis is when we stress test your overall financial plan to incorporate an indexed inflation so that it looks like you need more money each and every year, when in fact maybe you don't. Maybe your expenses are in control and you effectively don't need monies each and every year more and more and more. But if you look at what the purchasing power does over time, it erodes. And so if you take an example of what the impact of a dollar was back in 1920 and the value of that today, it yields $12.86. So that's a pretty significant swing. And so what we want to try to do, of course, is mirror the potential inflation risk that you have and the ability for your assets and your retirement to sustain a successful retirement in hopes that you don't run out of money while you're alive. And so as an example, if you need $50,000 a year to live in today's monies, over time, your retirement in a 50-year window is going to yield you a need for having over $365,000 of income each and every year. Now, do I think you're going to spend that? Well, the answer is we don't know, but the reality is that preparation is key. And one of the things that we want to focus on is what this actually means to each and every one of you, which is why we encourage you to stress test where you're at from a financial planning perspective. And so this is a little bit a discussion of the breakdown of the Consumer Price Index. And the Consumer Price Index is actually split up in two different parts. There's something called the CPI-U, which is what the government uses to assess inflation and actually adjust Social Security benefits. But the problem with CPI-U is it doesn't accurately disclose or reflect what a retiree goes through when they transition into retirement as far as their expenses are concerned. And so what CPIE is a form of CPI that looks at the cost incurred by individuals who are over the age of 62, as most retirees are. So in this particular example, the indexed inflation for CPIE was 2.1% last year. And the purpose of this is to try to gauge how this applies to you in specific. And so this is a pretty unique table to kind of give you an overview of the difference between CPIU and CPIE, and then our third column, which is what is CPIU, or what's best for you and your family. And so you'll notice that these numbers all over the map, from housing to apparel or transportation, and ultimately to medical care. That's probably the biggest transition. Your housing and medical care typically go up, right? As you age, or as we age as individuals, we're going to be spending more potential funds of our retirement assets on these particular topics or these categories. And so it's a pretty unique chart that you can have access to if you click on this government link that we have as a support feature. So this is a pretty interesting chart too, where it talks about the difference between the CPIU, which we talked about, which is the mirrored index for how the government assesses inflation and Social Security benefits. And the blue line represents all items as an expenditure, and then the red line item represents all items minus your food and energy costs. And so it's pretty unique that these things are not correlated, and in fact the spread between those two is pretty wide. And so another example of the need for you to be cognizant of inflation as a whole and be overly affected by the long-term impacts of that is to be prepared. And so the more preparation we do for this issue of the erosion of a dollar over your time in retirement, the better off or better prepared you'll obviously be. And so when planning for retirement, the effects of inflation are probably one of the biggest keys. And so as the key remains, we want to try to do our best to outpace inflation. We also want to be very cognizant of something called permanent loss of capital. And so the more that we stress these two particular items with our retirees, the better prepared they're going to be able to not only adjust as they get older and spend more monies on different things that they're currently not spending funds on, but in addition to that, they have the ability to understand what the fluctuation in the markets are doing and how that impacts their overall retirement portfolio, and ultimately what that means to their retirement income. And so the more prepared we are for that particular thought process, which we'll cover in the next few parts of this three-part series that we're doing for the value side of things, you'll have a better understanding of what the permanent loss of capital means. And so as we know as advisors, many fixed income assets in totality, they do very poorly in a rising interest rate environment. And so this is kind of a unique chart that talks about the actual return of your portfolio and the net rate of return if you incorporate inflation to that, and what it might look like if you were to take the pension as a disbursement, which most of you at Boeing have, and the difference between a year one pension, which provides you $2,000 a month in income, versus what it does after 10 years, that it goes down by roughly 25%, as you can see. So the same $2,000 a month in today's dollars, 10 years from now is roughly $1,567. And so it's a pretty big impact and a pretty big swing. And for those of you who have done some planning, kudos to you. Most people don't do as much planning as we'd like them to do. And so we feel pretty strongly about this being an important factor for you to transition into a successful retirement for sure. But mostly to be mindful of what is the impact of this going forward, especially if, for example, you take the pension dollars, which don't have the rising cost of inflation built into the ability for you to get more and more money each and every year. And so we're going to talk a little bit more about the specifics of the investment side of things in our part 2 and part 3 series. But basically, we at the Retirement Group employ 2 investment strategies. One of them is correlated to something called modern portfolio theory, which many of you might be familiar with, even though you might not know it, which is an effective, deliberate diversification of your assets, okay? So most of you probably are aware to one degree or another that you should not put all of your eggs in one basket. And so by default, if you just spread your money out amongst the options that are available in your 401k, you might appear or have thought to yourself that that's a way to diversify your money. And that's partially true, but the question really is correlated to if that's an appropriate direction of your investments and your retirement well-being based on your retirement goals and your investment objectives and pretty much your ability to absorb and or tolerate risk. So what you're trying to do when you do modern portfolio theory as a whole is just based on correlation minimization, which means that when you have assets that are uncorrelated, they work in opposite directions. So when one thing goes east, the other one goes west, or when something goes north, the other thing goes south. So this will give you an idea on what generally is described as modern portfolio theory. But something we do at the Retirement Group is focus on something referred to as margin of safety, which is correlated to 2 different theories of finance, one being behavioral and the other being a standard theory. And it's to help you avoid something called permanent loss of capital. And as simple as that may be, this is often overlooked when you have the diversification of your retirement assets by both definition of where your money gets placed and the vehicles that you're actually using. So what you're looking to do in an environment where you're employing margin of safety as a theory is to buy a bargain. Basically buying a stock that's valued at $20 a share and paying $10 for it. And so clearly in this case, you've created a margin of safety of $10 per share in that particular stock that you own. And some of the ways that you do that is by buying low price to book ratio stocks, low price to earnings ratio stocks, stocks that pay a dividend. These are some of the things that you would want to be mindful of if you were looking to employ a permanent loss of capital strategy to avoid that. And we'll talk more about that in the upcoming series, as I had mentioned. But you heard me a few minutes ago reference that most people do a very poor job in general in planning, and that's because we know that 74% of the people over the age of 50 don't have a written financial plan. And to be fair to you, there's really no reason for that because we're not the only firm that offers a complimentary cash flow analysis to you. And so all you have to do is spend a few minutes with us to outline the things that are important to you and how you envision retirement and what your expenditures look like or what you expect your expenditures to look like anyway, and then give us an understanding of what you've saved and accumulated over your working years so that we can put together this analysis to stress test where you're at. And it would give you a written financial plan. And so this always boggles me that the fact is most people over the age of 50 don't have a written financial plan when people like us are willing to do that as a complimentary service. And so we always feel like not only should you speak with someone who actually knows about the Boeing pension plan and the savings plan and the healthcare benefits and that kind of thing, you should always get a second opinion, even if you have a relationship with an existing advisor, to make sure that they understand those to the best degree they can so they can give you accurate and prudent investment and retirement advice. You also want to know what the fees are, obviously. I feel like this is one of the biggest elephants in the room often, where if I were to ask someone what they're paying in fees, most people don't know what that is. And this is probably a disconnect between the understanding of what you're gaining in value from a service that's being provided to you versus what your expectations are. And so often when those things get sideways, the relationship that you have with the advisory group that you're working with often does the same. And so we feel pretty strongly that this is not something that we take lightly. And so we want to make sure that you not only are disclosed what you're paying in fees, but this is part of our fiduciary responsibility to you to help us employ a strategy that's best suited for you and your family. And so you want to make sure that there's a team involved. You met one of our teammates at the beginning of the webinar, Mike. Mike is one of our teammates, along with a number of other advisors that are spread out throughout the country. And we have an investment team that talks about investment strategy and try to correlate that to your personal investment goals and your retirement objectives. Maybe the biggest or most important part of this entire slide is to understand what you expect when you engage in a service like ours. And so when you go and ask someone to take care of your life savings, what are your expectations? What is it that you hope to gain from that relationship? As in, how often do you wish to be contacted? How do you like them to communicate with you as far as the reports that are shown with you or the returns that are being done compared to certain market indexes, and planning for certain things like big one-time purchases, for example, on if you planned on buying a boat or a lake house or a piece of property or an RV or something like this. These are all things that you would want to have as an expectation as the client, to know what your advisory firm is going to bring to the table. And of course, we've talked a number of times throughout this webinar already about having a cash flow analysis done, which is something that we stress pretty regularly. So for those of you who are interested in either having some questions answered about your own specific circumstance and or scheduling a meeting with us to start a discussion on how we might be able to help transition you into a successful retirement, you can do one of two things here on this page. You can scan this code on the left that will allow you to get access to a calendar where you can be put on a calendar with an advisor that can help you address your specific circumstance and your goals and objectives and talk with you personally. And then you can also scan this LinkedIn page to the right that I mentioned at the beginning of the workshop that gives you access to watching our webinars through the LinkedIn page. So final kind of thoughts in the big picture of things as I kind of glossed through the important factors of inflation and what it means to you to understand and how to impact your future retirement decisions and so forth. We also want to remind you that as an independent firm, we weren't asked to provide any specific Boeing employees with any knowledge or information. It just happens to be one of our specialties, and we do a lot of work with Boeing people, and so we feel pretty comfortable talking to people about this particular topic with respect to transitioning into a successful retirement. And so it's important for us to disclose to everyone that we're here on our own terms, and as an independent financial planning and retirement planning organization, that's where you're going to get the most objective opinions and advice. And frankly, if I'm in your shoes, that's what we're looking to gain, is to have you understand what it is that's best for you, and if you're not on track to meet your overall goals and expectations, how to in turn fix that. And so with that, I want to be mindful of everyone's time today. We try to keep these things around 20 to 25 minutes at length, and we're going to see if we have any questions and give some final thoughts to Mike sewing up our workshop this afternoon. So we appreciate your attention. Mike, do we have any questions that are lingering that you see?
No, we don't, Patrick. But like Patrick said, please reach out to us. Give us a call at 1-800-900-5867. Hopefully you've had a chance to click on some of the links in the chat box. Lots of good information there as well. You're welcome to email us too. If you just soon do that, just email us at info@theretirementgroup.com. We'll get back to you. And as Patrick mentioned, please take advantage of all of our resources, including our complimentary retirement cash flow. We look forward to seeing you again at another one of our webinars, and we want to thank you for your time again today. Everyone, have a great day. Take care.